Good morning, everybody, and welcome to our April edition of our IFRS and corporate reporting webinar. And in April, we're looking at common errors in applying AASB 16. For all of those, I think across the world, that celebrated Easter. We wish you happy Easter. And then obviously in Australia, we also have Anzac Day coming. So it's a very short week. And thank you very much taking time in your very short week to join us for this webinar. I also want to start off by apologizing for the images. Then you can see me, then you can't see me. Apparently there's an issue with GoToWebinar and they're working on it. We've reported it last month, but for the time being, I'll be coming and going throughout the session, and apologies for that. When we look at common errors for applying AASB 16, you might ask, why are we talking about this again and why in April? First of all, we're talking about this again because AASB 16, I think, is the most famous accounting standard across the world. Everybody, when they talk about accounting standards or say, oh, you work in accounting standards, they would say, oh, AASB 16, IFRS 16, hate that standard. And Kevin and I love that standard. So the standard is notorious. So we keep on coming back to it because it creates a lot of problems for people across the globe. Then why do we talk about it in April? Because we are getting ready for 30 June reporting season. So everybody's starting to think about, have we accounted for all our leases correctly? Getting ready for the auditors. Do we have our disclosures ready? So very good time to talk about AASB 16. Now, as always, I'm joined by Kevin Frohbus, my fellow partner based in Sydney. So good morning, Kevin.
Good morning, Aletta.
And then also we would like to begin by acknowledging the traditional custodians of country throughout Australia and their connections to land, sea and community. And we pay our respect to their elders past and present and extend that respect to all Aboriginal and Torres Strait Islander peoples. As you know, our monthly IFRS and corporate reporting webinars, we're already in April looking at AASB 16. Next month, I would say, is our most watched, most attended webinar, and that is the Financial and Sustainability Reporting Update, helping entities to get ready for 30 June reporting. Each and every year, the best attended webinar, so don't miss that one. If you look at our sustainability webinars, we are working through AASBS 2. In March, we looked at Pillar 1 around governance, and this month we look at strategy and specifically climate-related risks. Very important webinar. Climate-related risks are also subject to assurance in the very first year, so an important aspect to focus on. So that's next week. Carbon accounting masterclasses. Now we've run a lot of carbon accounting masterclasses, 3 series across Australia over the last 18 months. We've had more than 500 people now attend these carbon accounting masterclasses, and we keep on getting questions. When's the next one? I missed the previous one. So we've decided to go virtual. So there will be one on the 4th of June, one on the 3rd of September, one on the 3rd of December. So if you've missed out on these carbon accounting masterclasses, we're running them quarterly for the rest of this year. Coming back to lease accounting, topic of the day. Last night, as I was preparing for the session, I was thinking, what are the top 3 concerns that clients are raising with us on lease accounting? Lease accounting still takes up a big part of my day, my work day. Last week we had a meeting with a client in Canada who's now adopting IFRS 16. and they contacted us because they had some concerns. We also have a number of clients in Europe and obviously a large number of clients in Australia. But what are the three concerns whenever people contact us? What are the things that they say? First of all, a lot of these entities would say, we do not have the knowledge, the time, and the resources to stay on top of lease accounting. Lease accounting IFRS 16 is quite different to other IFRS accounting standards in that it has detailed requirements and one could argue somewhat rules-based. And you have to stay on top of these rules. We also know there's been a number of discussions at the IFRIC around lease accounting. So to stay on top of this, really difficult. So stay on top of the knowledge, difficult. To have the time to stay on top of it, and to have the people to do lease accounting, absolutely the number one problem. The second thing is a number of people are saying lease accounting is difficult and it's time consuming, so time is coming up again, difficult, time consuming, especially if you do it in Excel. So a lot of people contact us around a technology solution. And then the third one, a number of clients have said, we do not have easy access to information to make decisions regarding our lease portfolio. And what they mean by that is, we do the lease accounting under IFRS 16, but we want some information to know, when is the end of a lease period coming up? And if the end is coming up, do we have extension options in place? Or not. So if we have an extension option in place, we need to make a decision whether we want to use it or not. If we don't have an extension option in place, we have to start renegotiating if we want to stay there, or if we want to move, we have to start to look for new premises. So if you want to make decisions around your lease portfolio, you need information that's easy to access. And this is slightly different information to the accounting information because this is around managing your leases, managing your premises, for example. So those were the three top things I would say people talk about when they contact us. Now, how can BDO help you to address these concerns? Now, the first one, if you do not have the knowledge, the time, the resources, at BDO, we have created an outsource solution. So you can outsource your lease accounting to our dedicated lease accounting team. So in Kevin and my teams, we have dedicated people that only do lease accounting every day of the week. So they are on top of the knowledge, the latest developments. They do have the time. It's their full-time job. And they also have access to technology that makes their job fast. So they can guide you. So you can outsource your lease accounting to us. So that's one option. If you look at lease accounting, I've included a link to our website where we explain how we do this. So the lease team, what would be the ideal client to outsource to us? If you have less than 100 leases, it's the best to outsource to us. However, we have clients that have up to 500 leases and they still outsource it to us. So it's not impossible, but this is the sweet spot. Let's say up to around 100, 200 leases. Also, you have limited ability, time, people to stay on top of IFRS 16. Maybe you don't have a dedicated lease, a person looking after lease accounting, so outsource it to us. Some of the benefits, you don't need to invest in software because we use our own software to do your lease accounting. So it's a lower cost and you don't have to worry about IT implementation. It frees up your employees to do other more important work. So we can look after lease accounting and your staff can do more important work. It will save you time to learn about all these requirements, etc. There's also an audit trail. You get professional assistance. We can guide you. We can update you. So, there's a lot of benefits in outsourcing to us. And usually what we do, what does a typical schedule look like? Between the 8th and the 11th of each month, we would contact you and ask, do you have any new information, any new leases, any changes? Please give that to us. And then, so we'll contact you. You usually give it to us around the middle of the month, between the 12th and the 16th of each month. And then by the end of the month, between the 28th and the 31st, we would give you your updated lease register. We'll give you your journal entries. All you have to do is process the journal entries, but we give you all the supporting documents in an Excel workbook, so that you've got a full audit trail for your auditors. And if there's questions from the auditors, we deal with those as well. So you really outsource the lease accounting problem to us, and we've got dedicated people looking after it. If you say you don't have the knowledge, we also have other solutions that work in parallel. We have a BDO Global publication, and this is a link to our website with the headings of all the articles that we've written over the last 6 years around lease accounting. I couldn't fit all the articles in, so I closed the drop-down menu and I just had all the headings. We've got an extensive list of articles on lease accounting that you could look at for guidance. And I've actually looked at these articles to put the webinar together, and I'm referencing a number of these articles because we write these articles for inclusion in the monthly corporate reporting insights based on problems we see in practice. The second issue is a lot of people are saying, listen, this is difficult in Excel. Now, really luckily, at BDO, we have our own technology solution called BDO Lead. And BDO Lead, therefore, is a software as a service solution. It's hosted in the cloud. You use it yourself. So you get access to your own deployment of BDO Lead. You can have a lot of users in there. One of our clients have 350 users in there, one of the big departments. And you do your own lease accounting. So you've got all your leases at your fingertips. We train you. We guide you. We provide an IFRS help desk. So if you've got any questions and you contact us, IFRS experts, that dedicated IFRS 16 team will help you with IFRS 16 questions, but also with the technology. A lot of people are saying the key benefit of using BDO Lead is that you are supported by IFRS people and not IT people. If there's an IT issue, we have IT people that can help, but we are finding that 99.99999% of the questions around BDO Lead is actually related to IFRS 16, and it's got nothing to do with IT or technology. So that's a really good option. We've got the software. By the way, when we do outsource lease accounting, this is also the software, amazing software that we use to do the outsource lease accounting. But if you want to manage your own leases, you can access BDO Lead and have your own deployment in the cloud. We've also included here a number of videos. There's a new introduction to BDO Lead video if you click on the play button. There's also a demonstration video to give you an idea what BDO Lead looks like. Absolutely amazing software. People would often ask me, Aletta, what are the 3 benefits, key benefits of BDO Lead? Number 1, it is completely IFRS 16 compliant. There's no workarounds in Excel. So whatever you are allowed to do under IFRS 16, you do it in BDO Lead. So absolutely one-stop shop. Number 2 is if you've got questions, you contact IFRS experts. You're not being put through to a technology IT person that don't know anything about lease accounting. And number 3, and this is a very practical thing, in BDO Lead, we have prepared a functionality that really assist our clients on a practical day-to-day perspective. And I'll explain. If you're in the finance team, you will be processing your journals every month based on what you believe are the latest information around your leases. And let's say you process the journals in January, February, March, all good, and in April, the property team will let you know that they've actually entered into a new lease back in January, or there was a CPI adjustment on another lease in February, or there was a modification to a lease in January. You didn't know about it. So you've processed journals January, February, March, and you find out about this in April. In BDO Lead, you can backdate those changes to January or February or March or whenever they happened. And not just that, BDO Lead will then generate a report that gives you a correcting journal. So in April, when you become aware of the latest information, you can process a correcting journal to true up what you should have processed in January, February, and March. In practice, our clients are telling us information is flowing slowly to finance teams. It's next to impossible for them every month to process 100% up-to-date, accurate lease information. So this functionality is a game changer. So that's the third benefit of BDO Lead. Please look at these videos. I've also included some other benefits of using a BDO Lead. It's created by IFRS experts. It includes all your contract details. It helps you with the ongoing management of your leases. There's an audit trail, so you can see exactly who made which changes. So a complete audit trail, it saves you time and cost, very easy to use, and obviously fully supported by BDO. I've also included here a list of all the features and functionalities if you're interested. So the different access levels for users, we've got 3 levels of access. You can have a complete register of your leases with all the lease details, all the reporting, the budgeting, all of those benefits are there. Absolute, amazing, top, state-of-the-art technology. And then the third issue, and that is people often say, listen, we can do the lease accounting, and it's our own clients would say, we use BDO Lead, or we outsource lease accounting to you, but we need to have access to information to make decisions. So what we've developed over the last number of months, and we've just released 3-4 weeks ago, is BDO has prepared a lease accounting dashboard to manage your lease portfolio. Now, this dashboard is in Power BI, and it sits on top of BDO Lead, whether you use software as a service, or it sits on top if you outsource the lease accounting to us. Now, this is revolutionary because if you've outsourced your lease accounting to us, you only got an Excel workbook with all your leases once a month. And that's when you had access to your lease information. With this dashboard, even people who have outsourced their lease accounting to us can have a dashboard, a read-only dashboard, where they can access their lease information on a continuous basis. And here I've got 3 examples of what we've prepared. There's a dashboard giving you an overview of your leases, as in whether it expires within 30 days, 60 days, 90 days, the next year. And you can actually drill on the pie chart, click on the pie chart. You'll see all the leases within that part of the pie chart, and you can drill into the lease. You can see the payments, the term, everything. Right, so you've got access to your lease information. You can't change it because we do that for you, and we want to keep control of that and keep it secure. On the right-hand side, we can also give you an overview of whether your leases, if they expire in 30 days, whether they've got an extension option or not. So if they have an extension option, you need a decision to be made, or if you don't have an extension option, you have to start a renegotiation or look for another property. And we also can give you an overview of what your payments are looking like over the next 12 months, etc. So we've created 4 specific dashboards that give you information and access to your leases. And I think this will be particularly useful for those of you who have outsourced your lease accounting to BDO, because for the first time, you've got real-time access to your information in BDO Lead through this dashboard. So if you look at our lease accounting services, we've got 3 services that could be used in any combination. We've got BDO Lead, the technology, the software as a service, which you use yourself if you've got a lot of leases. I should say the pricing, you can use BDO Lead even if you've got 10 or 20 or 50 leases. If you want control over it, we've got pricing that scales up based on the number of leases. There's outsourced lease management services where you give all the problems to us. We do it all for you, and we give you the journals and the information every month. And then there's the BDO Lead dashboard. Now, that dashboard can be used with number 1, BDO Lead software as a service, or the dashboard can be used with the outsourced lease accounting, where you've got the best of both worlds. You outsource it to us, plus you have access to the information through the dashboard. We also have a few hybrids. Some clients use 1, 2, and 3. They have their own deployment. They want us to still do the work in their deployment, plus they want the dashboard. So a bit of an overview to address the 3 key issues that are constantly raised with us. If we go back to some of the more technical aspects, the common errors in applying AASB 16, Kevin and I have identified 15 common errors. Kevin, when we did this webinar a few years ago, we had 10 common errors. It looks like AASB 16 is creating more and more common errors. So we've gone from 10 to 15. And I'll hand over to you to start with the first 5.
Thank you, Aletta, and it's really good to see, how things have moved along and how the products are emerging. It's really, really wonderful, and that's because leasing is embedded now in our culture. It's embedded in our systems and processes. I think those people who thought it would go away, it hasn't gone away. It's actually here to stay. So I think Aletta's right. The leases and the common areas are getting more and more. But I actually think that as we go through it, you will notice that having a good system and a process and a tool or software and embedding that in your processes and systems at your organization is really the way to catch these common errors, because all of these common errors are exactly that. They're things that if you don't have a system or a process, it gets dropped or it gets missed. So that's, you'll see the common thread. I'll start with the first one of identifying an embedded lease. And the reason why this one's been identified as the first common error is this is where it all starts. It actually starts with contracts and contract reviews. Might be just worth kind of running through in the first instance, what do we mean by a lease, first of all, which is on the right-hand side of the slide, which is basically any contractual arrangement or any arrangement with a counterparty that involves an identified asset, which that arrangement gives the lessee substantially all the economic benefits from using that identified asset, and where the lessee has the right to use or direct the use of that asset contains a lease. And what's really important in the definition is actually in the green box. It doesn't say that it is a lease, it says that it contains a lease. And that's really important in the accounting standard, because what this is telling you is that every time you sign a contract, you need to evaluate that contract to see whether it contains or embeds a lease in it. And the hint is in the wording, because what it's telling you is every lease that you organize, every contract or arrangement that your organization enters into should at that point be evaluated to determine whether it contains an embedded lease. And that means anything where you have a customer arrangement, or where you are the vendor, even business combination or asset acquisition agreements, all of those agreements, really any agreement that the company is entering into, needs to be evaluated to determine whether it contains or contains an embedded lease. So that's the hint. So the common area here is not evaluating all contracts or all material contracts for embedded leases at point of execution or when they're entered into. Great examples listed here, things like rental agreements for printers and photocopiers. I love that one. Um, that's where you have, and we have this too at BDO, where you've got printers on the floor. You may not think you're paying for a lease because you're paying per copy for paper or every time you push the print button, but actually, let's face it, there's a photocopier there, it's identified, you're getting substantially the economic benefits from it, and you have the right to direct that asset by printing on it by your employee. So there's your embedded lease. But it can take more ethereal sorts of lease agreements. The one I've actually seen a lot recently, it's not a new example, but it has reared its head lately. A lot of councils in the Sydney area or New South Wales area seem to be going sort of renegotiate leases with schools and other organizations to use sporting fields, and they get to use the sporting field for like 2 hours on a particular day of the week. Well, there's an identified asset there. You get to use the economic benefits from using that asset for those 2 or 3 hours a week, and you have the right to direct the use of it. So you probably have an embedded lease there. And so it really can be anywhere. Other examples are logistics contracts, dedicated fiber optics, data centers. Love that. Data centers are popping up all over the place. It's the next best thing. Even WeWork type locations where you get to use an office space for a period of time could be a lease. And I actually would kind of just like to say that Letta and I are both involved, as you know, in carbon accounting, and it's really amazing how many embedded leases we've picked up in the carbon accounting, which haven't been properly recognized for accounting purposes. You talk to a client and you suddenly identify that they are, they have fuel, which is going into their scope one calculation, but you recognize they have no leases on the balance sheet. So where's all this fuel coming from? And it turns out that they have these sort of crazy logistics contracts with the supplier. They didn't think they were leased contracts, but they're burning fuel on dedicated vehicles. So there's
Yeah.
actually a missing lease, and that's actually why this has sort of popped up as number one. Is we are finding through the carbon so many leases that weren't actually properly accounted for from an accounting point of view when you get into the carbon thing. So kind of get ready for that one.
Kevin,
Yeah, later. Yeah.
It's interesting that you say that because we've had a similar experience with our Melbourne clients. When we do that boundary setting policy, which is the starting point of carbon accounting,
Mm-hmm.
this is where we uncover all of these. And as you know, we always compare the carbon accounting with the financial report to see whether it's aligned and if there are differences, why they're different. So I
Mm,
agree with you. Embedded leases, carbon accounting is to put another focus on embedded leases.
mm. One last war story, just for fun on this one, is I do have a national client, and a national client who didn't seem to have any um, vehicles in Adelaide, because I had a look at their list of owned and leased vehicles, and I was down in Adelaide during the Fringe Festival period, and while I was at the Fringe Festival, I saw one of their trucks with their name on the side. I'm like, well, hang on. How come there's a client vehicle with their name on the side down in Adelaide? I know what their register looks like. I haven't seen it. And it turned out there was an embedded lease, which they hadn't actually evaluated properly. They'd even branded the vehicles. And so they're all over the place. And I noticed that because we were doing a carbon job for them. So I sort of picked it up by being out on the ground. So it's a really interesting story. It also is a sad reality that Aletta and I don't sleep and we're working all the time, even when we're down at the Fringe Festival in Adelaide. Moving on to when is a lease not a lease. This is actually a common error the other way. Once you've evaluated your contractual arrangements and you've identified the potential for a lease, there are situations where those leases actually are not leases, and so you don't want to inappropriately identify leases when they aren't leases. So this is again making sure your systems and processes are properly evaluating the substance of the arrangement and what's going on. A lot of these sort of the examples in the agreements often in the standards often talk about the capacity portion of a fiber optic cable. Basically goes when you're actually renting, shall we say, or have the right to use a capacity portion of a whole asset. So you might have the ability to use 5 out of 7 strands of a fiber optic cable. And yes, that is how it works. Um, or you might actually be able to use it at a certain time of day. You actually have to evaluate um, whether it is physically distinct and therefore might be a lease. So it's not physically distinct and therefore it cannot be an identified asset if, for example, your ability to use the capacity portion of an asset doesn't represent substantially all the capacity of the asset. And capacity can be numbers of strands, capacity can be hours of the day, it could even be data parcels. And you can also get this obviously in the oil and gas industry, capacity portions of pipelines. You also get last mile arrangements where you may or may not have a lease over the last mile of the pipeline. They are everywhere, and it comes back to, is there an identified asset, substantially all the right to use, direct the use of the asset, and then if it is physically distinct, does it represent substantially all of the capacity of the asset? Complicated assessments required at the beginning of each lease. Um, the last one is actually then just also um, how to interpret the substantive right to substitute. Now, this is a tricky one, and it happens in a lot of places. Um, so even if you have an asset that is specified, this is actually dealing with the first of the 3 criteria we mentioned. So do you have an identified asset? So it's the very first question. There's a lot of literature around this in the guidance. There's a lot of literature in the standards. There's a lot of literature also in the interpretations on how to interpret this. But one of the ways you interpret whether you have an identified asset in the very first question of the lease definition is whether the supplier has a substantive substitution right. Now, first thing I want to point out here is the use of the word supplier. That's a hint because it's telling you again that leases can exist in customer-vendor relationships. So it doesn't have to be a nicely defined lease arrangement. And often these things are actually guised as supply or service contracts, but actually embedded in there is some sort of a arrangement with the supplier that involves an identified asset. Um, but but interpreting whether you have an identified asset, that first question, um, even if it is identified as an identified asset in the agreement, you do not have a lease if the supplier has a substantive right to substitute the asset throughout the period of use. What does that mean? It means that the supplier has both of the following: the practical ability to substitute the asset with an alternative asset throughout the period of use, and the supplier would benefit economically from exercising that right. Now, this happens everywhere. The example on the screen here actually talks about a period of space at an airport, and you'll know what I'm talking about. You're walking through an airport, and there's someone got like a coffee cart standing on an area of the airport floor. The question then is that little area of floor actually a leased asset, an identified asset, or is there a substitution right? So, for example, could the coffee cart be, shepherded off somewhere else in the airport? And can the supplier, being the airport, do they have the practical ability to substitute that asset throughout the period? And would they benefit economically from exercising that right? And this applies everywhere. If you go into David Jones, or sorry, Maya, or any of those sort of department stores, and you've got different brands on the floors, they're probably suffering from the same sort of assessment. But it also applies even just to the coffee cart downstairs from the Sydney office, which we have outside here. Same sort of scenario is, has the supplier got the ability to practically substitute that asset or that area, and would they benefit from it economically? And you've got to have a look at things like, can they actually move the coffee cart? Can they take the signage down? Is it actually economically in their best interest? Would it actually cost them something to do that? And are they likely to do that? You have to go through that assessment. And we find not only the common error that it isn't considered, but when it is considered, it is applied incorrectly, these sort of concepts in in the standard. So I'll leave it at that in the interest of time, because I think that kind of gone through that. We've just got some other guidance here about the economic benefits and so forth. But those are some of the current common errors we find. Once again, you need an accounting position paper to go with your contracts. Every contract or material contract needs to be assessed to determine whether it's got an identified asset. All of those are either not done at all or done incorrectly, and the judgments are applied incorrectly. Build those into your processes. When to start depreciating a right of use asset? Great one. This one actually is a common error, because it happens often that the lessee or the person or the party leasing the asset doesn't doesn't correctly interpret um, not only the commencement date of the lease, but when it should be depreciated or amortized. If we're going to have a look at how this normally works in property, plant, and equipment, and this is an old standard, when you have an item of property, plant, and equipment, you normally start depreciating that item of PPE when the asset is available for use. Basically, what that means is when it's in the location and condition necessary for it to be capable of operating as intended by management. When you look at IFRS 16, there's a variation on a theme, but basically it talks about depreciation starting from the commencement date of the lease. And the commencement date of the lease is when the lessor makes the underlying asset available for use by the lessee. Now, this can be tricky because often, especially with property, the lessee will tell you that they haven't even accessed it to do their fit outs yet, but they've been given the keys. If the lessor has given you the keys or made it available to you, even if you haven't moved your furniture in there yet, it's available for use by you, and it's then ready for amortization or depreciation. So that's a common error we find in practice. I would like to say, and this is a bit of a generalization, so don't take this too seriously, but if you capitalize in the lease, it probably should be already available for amortization or depreciation. There shouldn't be a gap between when the asset is commenced or when the lease commences and when you start to depreciate. That normally is an indication to me that something hasn't been considered appropriately. So one of our common errors.
Yeah, Kevin, this one is, I think, is as a result of the confusion. All of us are so used to IAS 16 talking about it's available to be used by me, right? Where IFRS 16 has it differently. As soon as you've got access to the property, whether you're using it, whether you're renovating it, whether you just have the keys, you have to start depreciating. So I think that's the confusion, and it's a great confusion. We often find this error.
It can have material impacts on leases, absolutely. All right, incremental borrowing rate. This is, I want to say it's probably common error number one. I don't think we've actually nailed this one as a profession or as an industry. I think it's maybe not as prevalent at the moment because interest rates are sort of coming off a little bit and they've stabilized for a while. It was more of a common error, or at least there was lots of them when interest rates rose really rapidly, and people were using interest rates that were either old or they weren't updating them depending on those rapid rises. But basically, you need to use an appropriate incremental borrowing rate for each lease. There's two ways of doing it. It's the interest rate implicit in the lease, or if you can't readily determine that, it's the lessee's incremental borrowing rate. So what does that mean? Well, it basically means that you need to use, and this is the incremental borrowing rate one, a base rate for economic factors, plus financing factors and asset factors. Now, the best way to describe what an incremental borrowing rate is similar to what we're trying to achieve where we use the rate implicit in the agreement. It's asset specific, so it's specific to the asset that you're leasing. It's specific to the organization that's leasing it, so it represents their credit risk variables and financing factors, but it also is representative of economic environment you're in. In other words, you're not going to use an interest rate in Japan for an asset that's based in Australia. And similarly, you wouldn't use a base rate in Queensland if you were using the asset in New South Wales, especially if you're starting with things like treasury bonds in those states. But basically what you're trying to replicate is a lessee specific, asset specific borrowing rate um, per asset or per leased asset. And that leads us to the common errors, which is basically on the next slide. And I'll start with myth number 2 first. An entity can use the same IBR for all leases. This is a lease specific or an asset specific that is leased rate that is specific to the organization or to the lessee. Every lease should have its own IBR, and if it's not implicit in the agreement, in other words, it's not readily apparent from the agreement that you've been given particular financing from it, you actually have to go and calculate it and you work through that process. Myth number 1, the IBR is the interest rate that the entity pays on its other debts. Not appropriate, because the entity, when it pays debts, financing on its other debts, that's not asset specific or it's not lease specific. We have that all the time. Organizations will use their borrowing rate on their mortgage. Well, that might be an economic, the economic environment might be right, and maybe even the financing factors are right, but it's certainly not asset specific. You wouldn't get a rate of borrowing for your lease that would be equal to your mortgage rate, because your mortgage rate might be unsecured and it might be secured over assets that are different to the one you're leasing. And then the third common error, which is myth number 3, there are no practical expedients in IFRS 16. So this is not true, even though IFRS 16 requires you to have a lease rate for each lease because it's asset specific. You actually can use an IBR on a portfolio of leases when those leases have similar characteristics, and if the entity reasonably expects that the effect of applying that rate to the portfolio would not differ materially from applying IFRS 16 to the individual leases. A couple of tests there, so it's not you can just suddenly go and use a portfolio rate, but you actually need to first of all class the leases with similar characteristics, but then also need to do a test to make sure that it wouldn't differ materially from actually applying individual leases. So lots of common errors there. The main one being every lease needs its own incremental borrowing rate or discount rate, which is not equal to the rate of other financing on other debts, but there are some practical expedients available to you at that point to kind of undo that where necessary. I'll move on rapidly at a rapid pace in the interest of time. The per mean lease term. This is actually one of my favorite things in lease accounting. I think it is Aletta's as well. A lot of organizations say, "Oh, this lease accounting thing is not it's, it's all legally, contractually driven. It doesn't represent the substance of the arrangement." This is a good example of how the standard does try and represent the substance of the arrangement, because lease term is more than just the non-cancelable period in the lease. It's actually made up of 3 components. It's made up of the non-cancelable period of the lease, which is often the stated period, but then it also includes periods covered by an option to extend the lease if the lessee is reasonably certain to exercise that option. In other words, if you have the right to extend it and it's reasonably certain that you will extend it as a lessee, you need to include that. There's the substance part, because if you're planning to, or if there's reasons why you would reasonably exercise that option, you should include it from the outset, because substance over form. And it also includes periods covered by an option to terminate if the lessee is really certain not to exercise that option. It's a bit of a double negative there, but basically it's trying to actually take into account the reasonable, it's trying to take in the lease period if you've got a termination right, but you're not likely or not reasonably certain to exercise it. Once again, trying to get to the substance over form of what exactly is the likely period under this agreement that I'm likely to have an occupation of this asset, and then replicate that in the agreement. Now, the next slide is actually my favorite slide. I haven't actually seen the slide before, Aletta. I've seen it in different formats, but this is looking so much more visual. I know Aletta loves a diagram and she loves a visual representation, but it's basically trying to kind of put a timeline together and basically show you how the lease term is made up of various components. And it's also trying to factor in the lessor and the lessee rights to terminate. It basically talks about from your lease commencement, which also would be the date you capitalize your lease, which also would be the date that you start to depreciate your lease.
Yeah.
You then work out your lease term going into the future. Basically, it's made up your non-cancelable period. This is the period where there's no ability that the lessee has to terminate the lease contract. It excludes the lessor-only termination options in that. So that's your first component. You then add into that the periods covered by extension options that the lessee is reasonably certain to exercise, and periods covered by termination options where you're not reasonably exercising it, and that makes your lease term. And notice then that you can have periods beyond that where the lease contract exists, where there might be rights to terminate or no enforceable rights in beyond when you actually have a contract, which you would exclude based on reasonable certainty and other assessments of lessor and lessee termination rights and options beyond that. Now, there's a lot to unpack there, but essentially, and especially under the green bits on this slide, you would need to evaluate, most importantly, whether you have a right to extend that you're reasonably certain to exercise, and that as a lessee should be included. That's the common area we run into most often, where
Mm.
organizations, for example, they go into a leased premises, they're never going to leave because it suits their business intention. They've done a major fit out. Also, they're located in an area where they can't find another premises anyhow, so they're locked into that lease. They're going to be there forever. But suddenly they say, "Oh no, we're not likely to be there for long because we only take the non-cancelable period." And we're like, "No, no, you've actually got a right to extend, and you're reasonably certain to do that. You must include that in the lease assessment." Leave it at that in the interest of time and give it over to Aletta to do some items 6 to 10 on the common errors.
Thank you very much, Kevin. Kevin, that diagram, you would see the heading, it says Appendix B. It is a new diagram that I found in the updated BDO Global publication on leases. And that BDO Global publication continues to be an amazing document. So I found that last night. I went back to that publication as I do very regularly. So that's why you haven't seen it before. It's brand new. We'll go fairly fast over the next 10 because we only have about 10 minutes left, Kevin. So it's a minute each. It's rapid fire. Number 6, if you are renegotiating leases that are about to expire, we see some problems. And often this is treated incorrectly. And we ask the question, what if? What if a 10-year lease of a building expires, let's say in May in a particular year? And then from 1 June that year, that lease is on holdover and the entity is now renegotiating a new lease. Now, they are expecting to have a new lease term for 3 years. They're expecting that the payments will be 8,000 a month. And maybe that is because the previous lease term was 3 years. And maybe they previously paid around 8,000 per month. So this is what they're trying to renegotiate. And then only on the 1st of August do they finally enter into the new lease. Unfortunately, it's a lot more per month, 10,000 per month, and it's for 5 years. If this business has a 30 June year end, it's incredibly important to understand how to recognize for this renegotiation during the period of renegotiation. A lot of people argue incorrectly that when the lease expires at the end of May, and they now go into a holdover period, that lease now becomes a short-term lease. Absolutely incorrect. You make an assessment on whether a lease is short-term or not, to use that practical expedient, at the original commencement of the lease, which has been a number of years ago, 10 years ago, when you started this lease, and then you already realized you're going to use it for 10 years, it will end in May, it's not a short-term lease. If you now continue on a holdover perspective, you have to estimate how long you think, and you'll recognize on the 1st of June a modification to that original lease. And it might be we modify it for another 3 years at 8,000 per month, and that will be your liability as of 30 June in the financials. And when you sign the new agreement in August, you'll modify it again. So as long as you're staying in the same building and you're making changes to that original lease agreement, and it could even be in the form of a separate brand new agreement, as long as you are continuing to use the same building. It's not a new lease for accounting purposes, but it's a modification. So this is a bit of a combination of a modification, a holdover lease, and be very careful about this. Timing is very important. Number 7 is the ongoing changes to your lease portfolio. And Kevin, this comes back to the 3 issues that clients usually raise with us. To recognize leases on day 1, it might be difficult. It's doable. You come up with an IBR, you come up with a lease term, and you have a lease liability and a right of use asset. The problem is actually the ongoing changes to these leases and all the leases in your portfolio. And now this decision tree, which we've developed, I think back in 2017, I double checked last night. It's withstanding the test of time. It's still accurate. It's still appropriate. And this is still the diagram that our IFRS experts use every day when they do lease accounting for our clients, the outsource lease accounting. So new changes, there could be new leases. And with those new leases, you have to consider, is it a genuine new lease of a new asset, or are you continuing to use an existing asset, because then it's not a new lease, it's actually a modification. There could be reassessments or remeasurements of existing leases because there's CPI changes, there's changes in residual value, or there's changes in your assessment whether you'll use that extension option or not, use that termination option or not. So those are reassessments, remeasurements. Then there's modifications. So the lessor and the lessee agree changes to the original lease, or they put a new lease in place for an asset that was previously leased between them. And there you have to decide, is it a separate lease or is it not a separate lease? Now, a separate lease would be, there's an increase in the scope, and you add another floor that you're leasing in a building. Plus, for that other floor, that new floor, you're paying a standalone market price. So it's just another lease of a floor at market values. You can treat that as a separate lease. However, if you have a modification and in some way there's either a decrease in the scope or there's an increase in the scope, but you're no longer paying just normal market rates, you get some kind of discount, then you have to bundle it with the other leases that gave you this access to the discount. So it's not a separate lease, you bundle them together. And then the 4th category is if you've got termination of leases. Now, there's amazing things in this one diagram. It tells you whether you use a new discount rate at the date something happens, or whether you continue with your original discount rate. And we often see people changing their discount rate when they shouldn't, or not changing it when they should. And this diagram will give you an overview of that. It also tells you whether we expect a profit and loss impact or not. If we don't expect a profit and loss impact, it's because the change in the lease liability, or the amount of the change in the lease liability, is the same as the amount of the change of the right of use asset. A profit and loss impact, the change in the liability, the change in the right of use asset is different, and therefore there's a P&L impact that we expect, and if we don't see it, we know there's a problem. So I think a very handy diagram. In our common error number 8, we talk about CPI-linked payments. Now we know when we initially recognize a lease liability, you work out the net present value using your incremental borrowing rate of fixed payments, so fixed increases, or in substance fixed payments. And in that lease liability, we also include payments that are linked to CPI adjustments over time. But we include it in that initial lease liability based on the payment at that date. So if we're paying $1,000 a month, and we'll pay it for the next 10 years, but it will be adjusted by CPI every year, on day 1, we include $1,000 a month for 10 years. We completely ignore what the CPI adjustments will be in future. Why? Because we don't know what CPI will be. So we just say 1,000 per month for 10 years. So we do include the payment, but as of what the payment is today. And then over time, at the end of every year, when we adjust the payment based on CPI, whether it's 2.5%, 3%, or over recent years it's been as high as 5.6, 5.9%, when you make that adjustment, you update the lease liability at that date, and you make the assumption that all future payments will be that amount. So every year, if you've got payments that are linked to CPI, every year, every 12 months, you will have to update the payments for the remainder of the lease term. And this becomes time consuming and difficult, especially using Excel. But please look out for CPI adjustments. They create pain. The other one, number 9, is somewhat linked to a previous example. You have a new legal lease. A lot of our clients come to us and they say, here are our new lease agreements. We look at it brand new, signed yesterday, beautiful, but it is to lease or to continue to use a building that they've previously used. So it's a new legal agreement, but it's actually a modification for the purposes of IFRS 16. And therefore, as soon as you have that modification, you have to book that increase in your lease liability. Now, in this example, I would ask you to go and look at this example. It's a very good example which illustrates the difference between treating it as a new lease, because if it's a new lease, you book a new lease when you commence using the property. However, if it's a modification of an existing lease, then you book it once you've done the modification because you are already using the asset. And if this happens around year end, it can have a big impact on the numbers. And that's why I've included a link to that article. Number 10, what is the difference between expired leases and terminated leases? An expired lease, it reached the end of its lease term. So usually your lease liability is zero, your right of use asset fully depreciated. Can we just leave it? No, you have to remove the original cost of the right of use asset. You have to remove the accumulated depreciation from your balance sheet. If it's a terminated lease, it's terminated early before the end of the lease term, and therefore we would expect a P&L impact because you remove the remaining lease liability, you remove the remaining right of use asset, and usually there's a P&L impact that we also have to deal with. Kevin, we've kind of run out of time. We've got a minute left. I think maybe a way to deal with it, we've talked about it before, is maybe just to flag, for example, with subleases. This is an example for subleases from our IFRS in Practice, our global publication, where a lessor has to assess still whether a lease is a finance lease or an operating lease. And if you have a head lease and then a sublease, you compare the sublease period to the period of the head lease, and we've got a bit of an example there. And then we've also included the consequences of finance leases and operating leases. I'll quickly mention that make good provisions is a big focus for our regulator, together with other provisions. So the debit side, you have the choice: does it go as part of the right of use asset in certain situations, or is it a separate make good asset? And there's rules in IAS 16 and IFRS 16 dictating that, both of them subject to depreciation. So there's a classification issue on the debit side. On the credit side, the make good provision sits separate from the lease liability. You deal with it under IAS 37, and therefore that unwinding of the discount is under IAS 37. Kevin, I'll hand over to you very briefly because you are absolutely in love with impairment. So impairment testing of right of use as fast
Impairment,
as
yeah, that's fine, Aletta. Yes, I am in love with impairment testing, and I think impairment testing is also becoming more exciting now that carbon and all those are starting to kind of come along. So impairment's never gone away. The key problem with impairment testing actually starts with the way you set up your leasing at the outset. Impairment testing normally follows um, the concept of, is it part of a CGU or is it a standalone asset that generates its own cash inflows, largely independent from other assets? Because normally, if it's not part of a CGU, it's tested independently for cash as cash inflows. Otherwise, it's part of a CGU test, which is sort of more asset grouping testing. There's actually guidance in the standard on how to determine components of leases or components of contracts, and lease components are separate lease components if two conditions are met, which are on the left-hand side of the screen there. It basically boils down to interdependencies with other assets, which is similarly aligned with, is part of a CGU or does it generate its own cash inflows? Technically, under the accounting standard, you should actually be accounting for all lease components separately. So you shouldn't be accounting for um, floors in a building as one building. They should be accounted for as separate floors if they actually meet the separate unit of account criteria as separate lease components. And that then allows you to align it with the impairment testing. Is it part of a CGU or is it got its own independent lease test? You could technically have, as the example in this example shows, 5 floors in a building, 2 of which are subleased and therefore they're their own cash inflows and therefore they're tested by themselves, and the other 3 which are included as part of a broader CGU for testing, depending on how they're identified as separate lease components. But the key takeaway on this is, if you get to this part and you're doing the impairment testing, and at that point you realize you've actually got separate lease components, you've probably set them up incorrectly in the calculations themselves right at the start.
Correct. And Kevin, we saw a number of these during COVID where people reduced floor space. And, if we set up the floors as separate units of account and they then get rid of certain floors, it was a much easier exercise than now trying to work it out and consider impairment implications. So I think this unit of account up front is really important and shouldn't be overlooked. Then in number 14, now this is one that I'm dealing with very regularly. And this afternoon, I've got another meeting with a client about this because there's a lot of movement in the market, maybe not IPOs, but where some businesses are buying other businesses, a period of consolidation, I would say. And therefore, there's this interaction between IFRS 16 and IFRS 3. So first of all, you have to remeasure your lease. The acquirer will have to remeasure the lease liability at the date of acquisition of the new entity, because from the acquirer's perspective, it's a new lease. And therefore, the acquirer often also has to use their incremental borrowing rate at that date. So you work out this lease liability, which will be different to the lease liability that has been booked in the records of the acquiree. But that's only the start of it. The lease liabilities are different. But the second thing is, you also, the acquirer, have to recognize the right of use asset at that acquisition date as the same amount as the lease liability that they've just calculated it. The acquiree will have the right of use asset at a very different amount because it would have been depreciated in the past. So the right of use asset at acquisition date is reset to the lease liability in the records of the acquirer. And the other thing is, we need to make an adjustment for favorable and unfavorable leases. Now, this could often results in the 2 sets of books. So we need lease records for the acquirer for the lease portfolio that are very different to the lease records that will appear in the books of the acquiree going forward. So just to know, often as a result of a business combination, if the acquiree continues to report and the acquirer reports in consolidated financial statements, the need for 2 sets of books. And then finally, coming back to our favorite holdover leases, if you go into holdover, so you've reached the end of your lease term, but you want to continue to use the asset maybe while you're renegotiating, etc., it doesn't mean that lease is a short-term lease. You have to make an estimate of how long you'll be there, and it links back to one of our previous common errors as well. Now, if you need assistance, just want to reiterate, we can help with lease accounting. At BDO, Kevin and my team actually specialize in lease accounting. This is what we do. This is what we're known for, because we've got fantastic technology solution, we've got dedicated staff, and we've got this dashboard. You can also subscribe for our monthly insights, and you can subscribe for our e-learning. You can also contact our IFRS and corporate reporting national partners to assist you. And then sustainability, carbon accounting, and lease accounting are very closely linked. This is an overview of our services and the people you can contact in the various locations. And then we also have our partners that provide sustainability assurance, who you can contact. Kevin, thank you very much for joining me today in the short week to present the session. Thank you for our attendees. I hope you found it useful, and please reach out to us on how we can help you with your lease accounting. Have a lovely day.
Goodbye.